Hey everyone, and welcome back to another edition of Ray's Reviews. And in today's video, I will talk about some of the concerns that Gary Gensler, chairman of the SEC, has about cryptocurrencies and crypto regulation. Now in the past, he noted that about 80 to 85% of crypto trading involves stable coins, and he is obviously worried because this bypasses the traditional banking system. And of course, Gary Gensler also lived through the dot-com bubble as well, where there were several promising online businesses that went under and took the investors' funds with them. Now, if you're brand new to Gary Gensler, not only is he the chairman of the SEC currently, but he also used to be a professor at MIT teaching blockchain and cryptocurrencies, and he was also a former partner at Goldman Sachs. So in today's video, we'll take a look at crypto regulation, and we'll also take a look at the lessons that we can learn from the dot-com bubble. So stay tuned and let's go. Now, if you're unfamiliar with the dot-com bubble, 20 years ago, dot-coms took over the Super Bowl, just like how the crypto industry took over the Super Bowl this year. Like in 1999, there were only 2 dot-com companies advertising in the Super Bowl, and then fast forward to 2000 and 17 dot-com companies started advertising. And it was kind of like the same thing where in 2020, no one was talking about crypto, and then January 2021 hits and everyone is talking about crypto again. But let's rewind back to 2000. And at this time, the first major brands were getting born online and getting their first taste of mainstream marketing's highest peak. After all, this was the future. The internet had arrived and business would be transformed forever. Or would it? After all, what good is crypto if it doesn't stand the test of time? And we're really looking at crypto companies that will be around 5 years from now, 10 years from now, and even 20 years from now. So back then, or even now, people were saying a Super Bowl ad is the ultimate stamp of legitimacy for a company, or is it? So let's take a look at some of the companies from the 2000 Super Bowl that advertised and see how many of them are still around today. All right, first company, ourbeginning.com. So this was an online retailer of wedding invitations, birth announcements, stationery, and more, and the company bought Super Bowl airtime for about $4 million. And it was a good business model, right? After all, the wedding industry is massive, right? Well, it is, but Our Beginning failed to execute, and less than 1 year later, they filed for bankruptcy due to poor cash flow management. Second company, pets.com. Who can forget the Pets.com sock puppet that was so popular that it was a balloon in the 1999 Macy's Thanksgiving Day Parade? Now, Pets.com was a dot-com enterprise headquartered in San Francisco that sold pet supplies to retail customers. And at the time, it looked revolutionary. The pet market was obviously huge. And they started operations in 1998, advertised in the Super Bowl in early 2000, and by November 2000, bankrupt. So perhaps Pets.com was a little too early to e-commerce, but their business model was flawed and they were also a victim of the dot-com bubble. All right, last one. Netpliance.com. They were a company that manufactured inexpensive internet appliances, which were these small and cheap computers that could only be used for internet browsing. And they sold their eye-opener web browser machine for $99, which was a loss as the actual cost of the machine was anywhere between $300 to $400. And they thought that they could sell the machine as a loss leader and make it up by selling monthly internet subscriptions. But what ended up happening was that people hacked the devices to use the computer offline without the internet, and by January, Net Appliance left the internet appliance market. There are too many companies to talk about, but out of those 17 companies that advertised, a majority of them failed, a few of them merged, acquired, or continued along, but kind of died a slow death, and none of those companies are really relevant today. No one really talks about them. However, there is one company that not only survived, but sort of thrived and still advertised in the 2022 Super Bowl, and that company is none other than Etrade. And what is Etrade? They are a financial services company that lets people trade stocks, ETFs, and other investments. And of course, they're getting into crypto themselves. And that is why I'm a big fan of crypto exchanges like crypto.com, because the business model is very simple to understand. And if done right, they have the highest chance of survival versus other types of crypto projects. All right, no more shilling. Now, with that said, did a lot of people lose a lot of money during dot-com? Absolutely. I had friends in Silicon Valley that are a little older than me, and they were all millionaires in 2000. And if they cashed out of their stock options then, back in 2000, I'm sure that today they would be chilling on a beach in like Phuket, Thailand, with a Singha beer on their left hand, enjoying life to the fullest, and with their right hand, they're also enjoying life to the fullest. But instead, today, because they didn't cash out on time, they are still looking to find a girlfriend in San Jose. Oh, sorry, this is a crypto video.
Wait a minute.
I mean, they are still trying to invest in the best cryptocurrency like me and you. Now, the cryptocurrency industry is the Wild West right now, and Gary Gensler and his staff will be very active in deciding what comes under their jurisdiction. One of the biggest things that people obviously want is like a spot-based ETF, and right now he has refused to approve a pure play Bitcoin ETF, although futures-based ETFs are approved. And I think if a Bitcoin pure play ETF were to be ever approved, I think that the Greyscale Bitcoin Trust Fund, or GBTC, will be the first one to be approved. But let's move on to some of Gary Gensler's concerns. And let's start off with some of the statements that he made, and then later I'll actually play one of the clips with him actually talking. So he said, these crypto platforms play roles similar to those of traditional regulated exchanges, thus investors should be protected in the same way. Now, a traditional regulated market would be something like the stock market, where if you were listed on the stock market as a public security, there are annual audited financial statements where an auditor would verify the accuracy of the information that is reported to the public. But in the crypto world, it's the Wild West. Obviously, last year, there were more than $14 billion stolen either through scams or cyber attacks. Some of the most notable scams in 2021 was like the SavetheKids Scam, which was a token that was supposed to have a charity element to it. But what these social media influencers did was they basically promoted the token with official promotional videos and even their image on the Save the Kids official website. And soon after the token officially launched, they basically bailed. The majority owners sold the token, and then the crypto soon bailed, and a lot of investors lost a lot of money. And another example would be like the Squid Token Scam, which was basically used to leverage the popularity of Squid Games, which was a viral hit in 2021.
And now the market, oh, it went to zero.
Oh my god, even though oh my god.
And Squid was billed as a token that would be used for a new online game inspired by the Netflix series. And people were so caught up in the gaming hype at that time and the popularity of Squid Games that many thought that Squid Coin would be a good investment and that it would be like the next Axie Infinity. In fact, one investor poured his whole life savings of $28,000 into Squid, and the token eventually plummeted to almost zero. And the developers made off with an estimated $3.38 million, and a lot of people lost a lot of money. So some of Gary Gensler's major concerns are surrounding investor protection, and now I will play a quick clip from him.
And yes, many tokens, many crypto tokens have been found in the past to be securities. And I'm not trying to prejudge any one token, but probability weighted, there are many of these tokens on these platforms.
One of his major focus areas is regulation around crypto exchanges, lending platforms, and the actual tokens themselves, which he feels there is a need for disclosure to protect the public from fraud and manipulation. Now, does Gary Gensler have some good points? Well, there is a lot of bad information out there and a lot of dishonest social media influencers, and there are a lot of young, impressionable people that haven't really done their homework or research on certain assets. They basically listen to their favorite social media influencer, they buy a token that could be a rug pull, and they end up losing everything. And a lot of people haven't really lived through the Dotcom era, where it seemed like the party would never stop until it did. And then, just like how there were a lot of failed Dotcom startups, in the next couple of years, we're gonna see a lot of people's favorite crypto tokens failing as well. And one of Gary Gensler's major arguments is that if you are issuing a token and raising funds from the public, and the public is anticipating profit from this token, this essentially constitutes as a security and will fall under securities law. Now, obviously, the most major recent news was Celsius stopping the EARN program for new non-accredited investors, and this obviously led to a lot of backlash. After all, one of Celsius' goals was to help the average investor build wealth, and the average person is not an accredited investor. What this average investor in the past would have done was dollar cost average into certain crypto tokens, put them onto Celsius, and earn a yield from those tokens. But now with the Gary Gensler SEC regulation, you're taking away that right and ability from these people to do so. And a lot of people using Celsius, they have actually done their homework, they do know what they're doing, and they fully accept the risks of the crypto tokens that they're investing in. They see the problems with the traditional finance system, and that's why they're in crypto. And it's not like keeping money in a bank doesn't come without risk, or investing in the stock market. After all, with sky-high inflation, if you just kept money in a savings or checking account accounts in the bank, you'd be losing money as well. And the stock market is also heavily manipulated with short sellers and large hedge funds. So some people would say that these unaccredited people are getting unfairly punished, and it's not at all about helping them, because now they have to go back to like the traditional banks and traditional finance market, and traditional banks are offering like 0.01% yield, and the stock market, obviously there's tons of manipulation and insider selling. So what do you guys think about all of this? Is there a healthy balance that needs to be made to really help prevent fraud and manipulation amongst these dishonest social media influencers? Like to really help these impressionable people that haven't done their research. Like at least when you buy a stock like Tesla or Lucid Motors or Google, you know that an independent auditor has looked at the financials and issued an independent auditor report, and that full disclosures have been made so that the public can be aware of all the potential issues. But when you buy a cryptocurrency, which acts like a security, none of this has been done. And how would you feel if someone that you know and loved got taken advantage of by these dishonest social media influencers? Or do you think it should be more of a free market where anytime you purchase a crypto token, you understand that the upside can be large and there is definitely an anticipation of profit, but you also understand that there is a speculation element to it and you could also lose? Like Gary Gensler in the SEC is not stopping you from going to Las Vegas and dropping 50 G's on the slot machines or on roulette. And after all, you understand that when you go to Vegas, there is a chance you might lose, but you think it's still fun, and the chance that you might win big is more important to you as long as you gamble responsibly. And perhaps many crypto investors do fully understand the risk that they are taking, and investing responsibility with crypto assets being just a portion of their net worth in a diversified portfolio along with real estate and stocks is what they are doing. But they are still looking to win big and still be early. After all, with sky-high inflation and extremely high real estate costs, how are young people supposed to get ahead and achieve their financial goals, buy a home, and start a family? And perhaps crypto is this generation's way of achieving financial freedom. So is there a healthy balance that needs to be made? Have you guys considered both points? What do you guys think? Do you guys think there needs to be a balanced approach in terms of crypto regulation? What lessons can we learn from Dotcom? Let me know your thoughts on the comments below. As with anything and everything, please do your own due diligence and research. Don't trust anyone, including myself, unless you've done proper due diligence for yourself. And with that said, I hope you guys enjoyed this video. Please like and subscribe if you did, and I'll see you guys in the next video. Take care.